Hi guys, it's Chad Larson with MLD Wealth Management Group of Canaccord Genuity. I'm joined here today by Travis Robinson, Senior Director and Head of Canada Financial Advisor Channel of the S&P Dow Jones Indices, a division of S&P Global. Travis is joining me today to discuss, among a myriad of other things, as they're one of our external partners that supports us in the development of our investment strategy via Invesco, with some of their ETF and index-backed products. Travis and I were going to talk a little bit about today some of the things that many of you and I have talked about over the last number of weeks through COVID as we develop content through this period of self-isolation and stay at home. But here we are with the economy thawing and people going back to work. But really about the idea of and around portfolio construction of how not all ingredients created equally. I think traditionally, and Travis will speak to a little bit about the genesis or the history of the S&P and the Dow of where we've come today, but many of you understand the very basics of portfolio construction. You've got Canadian equities, US equities, international equities, fixed income, and some myriad between preferred shares and bonds. But in line deeper with that, we have used mathematics, academia, research, and forecasting in the creation of products to do things such as having equal weight or low volatility strategies and or ESG. And we're going to be talking about a few of those over the next few video series. But today we're really going to more focus on the low volatility strategy, because definitely right now, more than anything, if you were at the grocery store and looking at 3 different cans of soda, I think all of us would prefer to open up the soda can with least volatility from having what we've gone through. So over to you, Travis. And again, thanks for being here today. If you could just tell us a little bit about some of the background and the genesis of the S&P Dow Jones and how this all, how you support us in the creation of portfolio construction.
Yeah, you bet, Chad. And thank you for having me today. To level set things, like you said, if you're using the anecdote of 3 cans of soda, I think you're probably familiar with some of our biggest brands, right? The Dow Jones Industrial Average, the S&P 500, the S&P TSX Composite in the 60, which is actually a partnership between S&P and the TMX Group in Toronto. So, we have a long, rich history of benchmarking and creating indexes. So stock pickers can measure their effectiveness against a benchmark, whether that's in Canada or in the US. My comments today, when I talk about the low volatility index, the version I'll talk about today is the S&P 500 version. We actually calculate a TSX composite version as well. So we'll get into that here in a bit. But again, the history of S&P Dow Jones Indices dates back to the 1870s when Dow Jones started. And then of course, the S&P 500 comes along about 50 years later and is pretty much the default benchmark for the US and large cap US companies. And so we'll dive a bit more into that. But I think a little bit of context for where we are right now and what we've all been going through. And if you've been glued to the news like I have, you've probably had more than your fair share of doses of things about the pandemic and even about the markets. But from our perspective, a few interesting things really do stand out. One of those is the volatility, and we felt that in our portfolios. We see that in just measurements of volatility in both the Dow Jones Industrial Average and the S&P 500. So if you look at the annualized price volatility of the Dow back to 1896, you can see the shifts in volatility over time, and the average is something below 20% depending on the period. But year to date in 2020, and this data is through April 8th, year to date, it annualized at 62%. So if we were to stop and annualize the year and we continued it like this for the rest of the year, this would by far be the most volatile year we've ever experienced. And I think a lot of things have gone on in the last 125 years that contributed to volatility. I mean, a couple of wars, Spanish flu, things that have already happened, and this is still one of the most volatile periods we've ever experienced. So it's unprecedented. I'm sure there's a huge spike in the use of that term, but this is just another data point to reiterate. This is a first for many of us, and we are trying to adjust and iterate as we proceed. And you'll see here, we're partners with the SIBO, which is an exchange in the US, to calculate the volatility index. And some of you have probably heard of VIX, which is the fear gauge, tells us about volatility of the S&P 500. The last slide was the volatility for the Dow. This is the volatility for the S&P 500. And again, to break 80 was unprecedented, but to break 80 and then stay up this high above 40 for so long is also quite unprecedented, even considering the global financial crisis. And what a reading, and this reading is back from early April, and it's still in the high 30s, depending on the day, it's in the 30s or 40s. This reading, what this tells us is expect more turbulence. We don't know which direction, it plus or minus, but a reading of 43.35 on April 8th tells us that swings are expected, and we see this in oil, high volatility gauge in oil, gold in stocks like this, and so we expect big swings. And I think that's, a lot of times folks work with someone like Chad to then plan around that and to help you sort through what the best approach is and which risks we want to manage. And so I can talk a bit about that.
Yeah, it's interesting. We only focus on things like on volatility. We're all very tolerant of upwards volatility, but volatility isn't necessarily a bad thing. But it does draw us to point out that there's swings, and they can be both ways. I think we're definitely in a scenario right now where we have a lot of positive things going for us. Unprecedented. I keep using the expression, the Fed has brought a veritable bazooka to the party with liquidity. We're starting to see the tolerance of more bad news and being less sensitive to it. So as much as you can never expect, or you can never time a black swan event, which would have been textbook for this pandemic, we do have set the scenario for potential white swan events, and there's some upwards volatility that could be there. And then those positioning strategies are going to be paramount. It will be a very interesting year. We could see advancements on vaccine. We could see more positive sentiment build as more states and provinces open up for business and things move forward, or the inverse. We're at the front end of just an absolute tsunami of poor economic data. And albeit the markets are forward-looking vehicles, will we fatigue through that? And as states and provinces thaw, will we see? Obviously, we're going to see more infection and then cases spread, and it'll be up to health authorities to manage beds and all of that stuff. But carry on. But I just want to make that point that the volatility can be in our favor, but it is definitely something to understand. You're playing in the pro leagues when you're trading in and around periods of high volatility.
Yeah, for sure. And I liken it to good cholesterol and bad cholesterol, right? Volatility works in both directions. To the upside, we want it because it means we're making more money, but then to the downside, it can be very harmful. And of course, the volatility we saw in March was harmful, and then the volatility we saw most of April was good. It was recovery volatility. And you mentioned the bazooka from central banks, and of course the U.S. and this data is again from early.
Here's our slide. You're welcome.
Yeah, exactly. The U.S. and other banks, central banks, have all stepped in to fill the hole, and I don't think I've seen a better illustration of what the hole looks like and how it's been filled than this slide here that one of my colleagues put together. So on the left, you have the total stimulus announced through March 31st, and on the right, you have the total of the loss in market cap, or the value of all the companies broadly across the globe of those publicly traded companies. And as you can see, they match up quite well. From February 19th to March 31st, 14.9 trillion in value was lost in the markets globally, in the BMI, which is a big, broad global benchmark, and 14.7 trillion in stimulus was announced during that same period. And so again, that is part of what has helped the market recover in April, is seeing central banks react so quickly, so swiftly, to backfill that and stabilize markets. Warren Buffett just over the weekend had his investors meeting and talked about this stimulus actually made it hard for him to go buy companies in distress because of how quickly the markets recovered. I think it's debated, there are people on both sides of whether that's a good thing or a bad thing. But if you were invested in the market and you needed to get back to even, this was certainly a good thing for those who were invested and currently participating in the stock market. So transitioning from there, I had mentioned we have a rich history in indexing and benchmarking. We're best known as in terms of research for putting out a scorecard twice a year around the world for just about every developed market that you can think of, that measures the effectiveness of indexing and the effectiveness of stock picking. And my career has evolved from early on working on within the part of Merrill Lynch that was the stock picking part and research, working with the research folks and the portfolio managers, to today working for an indexing company. So you can imagine where my career has taken me. But part of that has been seeing the evidence that using an ETF or an index-based fund can be very effective to get you exposure to broad asset classes. And so just a little bit of context here. If you're curious, you can Google the SPIVA scorecard. It's a dense publication, but it'll show you our measurement of active managers over time. And we've been doing it for almost 20 years in the US, about a decade in Canada. And the way you read our results, and you can see in the top left there, the Canadian results over the last 1, 3, and 5, 10 years, is that's the percent of managers underperforming their benchmark, trailing their benchmark, which is the TSX composite. So the managers who fit into the category that they're competing against the index, the TSX composite, you can see over the last 5 years, 9 out of 10 of those managers are trailing the benchmark. And so many investors would have been better off owning an ETF or an index-based solution. Now, the other side of that coin is, when you work with a manager who can put up performance and who can outperform, what it tells me is you're in the minority, and that's something special. And that's when I think it highlights the value of a manager who can outperform their benchmark. And there's certainly plenty of those out there, and they're important to the ecosystem of portfolio management and stock picking. It's just a very hard task to pick those managers, and you need a lot of help in doing so.
For sure. It's a good kind of segue, because I think everyone sits there and goes, am I performing? Running a multifamily office, our predominant goal is meeting our clients' benchmarks over a full cycle of investments. And my job as a portfolio manager is to construct a portfolio that gives our client families the highest probability of achieving those results over a market cycle. And I think more than ever, understandably, ETFs and indices dominate the core infrastructure of what we do. There's just no possible way from a scale, cost, and execution standpoint that we can compete to do round out prudent market diversification without the use of product. And I think more so, I would add on to the commentary is that it's a advisor's job to help build that recipe. And it's when you really strip back what a benchmark is, or you are the benchmark, and the only way to beat it is to tilt away from it. So you're kind of comparing apples to fish sometimes. I'm kind of caught in the media saying all the time is that if I'm to my benchmark are my clients' goals, and then ultimately we start with a macro view of the world, start with the map very similar to this, and look at what are those macro forces, like where is the sunshine, where are the potential hurricanes, where are the potential tsunamis, in economic terms, and where should we be allocating capital? And then we look to take those building blocks. And furthermore, I think as we, probably and we didn't rehearse this, we'll be teeing up kind of the next phase of this conversation in when we do determine the geography, perhaps we're going to discuss the S&P 500 today. The U.S. economy is and will continue to be the dominant leading economy of the world. How do we construct that, and how do we find styles that suit and are more in line with our clients' goals, whether they be income, whether they be low volatility, and what are the client's needs, tolerances for risk, and expectations. So I think that I'm 100% in agreement, and I'm publicly quoted all the time. I think the ability for an active manager, to be a benchmark to an index is a challenge, because the benchmark is the benchmark. So you're either taking on more risk or you're overweighting a sector, and that style drift is something that we allow as portfolio managers, as many of them just hug alongside. But it's about creating the right recipe for each individual family that you work with.
Yeah. And this is really quite in the weeds, right? A lot of this goes on in the background. I think the real benefit to all of us is that it makes everyone raise their game in the solutions that are offered. And it's also created a number of new options out there. It's made a more competitive marketplace. And this next slide shows you an example of what I mean. Again, back to the 1870s, the Dow Jones comes along, and that's a price-weighted index. So the weight of a company in the index is simply driven by the value of the stock itself, which is a really flawed way to measure the market, just because that value can be manipulated simply by stock splits. But that's how we started, right? And probably didn't know better for a long time. Along comes the S&P 500, which is market capitalization weighted, meaning Apple at $1 trillion is weighted by because of its value relative to a company that might be a regional bank and have a much smaller footprint. And so the lion's share of the weight in the index goes to that big company like Apple versus those small regional companies. But there are some flaws to that. It's just an approach to indexing. And so we've really seen this evolution even in our space in indexing, where we've gotten more sophisticated and more thoughtful about what do we want to accomplish. And so in that first set of bullets there, you see broad market, and I'd say that's generation one, the Dow Jones Industrial Average, the S&P 500. And then generation two is more specialized, where we start to drill down and break those broad market indices into subsets. And you may be familiar with sector ETFs or sector indices, where you can isolate individual sectors or industries, or size and style, large cap growth or small cap value. And so that generation two was starting to break the broad categories into subsets. But today we're in generation three, where we're beyond just breaking the big categories down into pieces, but instead we want to pick a group of stocks that have a similar pattern of returns or characteristics, or isolate something that matters to us. So that might be environmental, social, and governance characteristics, that because that matters to us, we'll isolate those characteristics and build an index around that. Maybe our concern is volatility, and now I'll talk about the low volatility indices, and that's a simple methodology of saying, let's screen this whole universe and just isolate the companies that have exhibited lower volatility over the last year. And if we do that over time, we can expect lower volatility, and hopefully we'll end up enhancing our returns in the long run. So let me get into that a bit. I promised you I'd talk about the S&P 500 Low Volatility Index. It's one of many indices that we calculate in the low volatility suite. This slide's what's known as an up-down capture ratio slide. So it shows how much of the upside or up market we participate in a low vol screen, and how much of the down market you capture in when the market pulls down. And you can see the historic results. And again, these are averages. So just like if you dress for the average temperature in March outside, you might be okay, except for those few nights where it gets down to well below zero, right? And so we can't just rely on the averages, but it gives us a good insight into the characteristics of this type of screen.
Yeah, let me pause there, because I talk about it, and we definitely go down the path in our industry with like, oh my God, here comes the math if you're looking at that. But people ask how we create portfolios and what an optimal or the holy grail of a portfolio is, whereby in a perfect world, if you just own beta or if you just own the market, you're going to go up with it, you're going to go down with it. As we go into Gen 4, as we're discussing, where we have whether they be quantitative screens, whether they be factors, and then we're about to go to this big long math equation and test all of my statistical and calculus abilities that I lived through in university. Kidding. We're looking at a scenario where we take a certain amount of capital, and if the market goes up, we want to get as much of that goodness as we can and catch all those sun rays. And if the market goes down, we want less of that downside. And so that's that optimal scenario where you can have you don't have to eat all the cake on the upside, but you definitely kind of don't eat all the garbage to the downside. So that would be my analogy to that.
Yep. Well, and a good, just kind of that, you mentioned all the math and the Greeks here. We can dive just a little bit into it so that we're all on the same page about what I mean when I say low volatility. That's referring to the stock screen that we run. So every quarter, we take and look at the last year of price volatility of all the stocks in the S&P 500. And we just rank all 500 stocks in order of least volatility to highest volatility. And we take the first 100 out of there. So looking back over a year's worth of trading, we rank them by their price volatility. We keep the 100 with the least volatility, and then we weight them. So the least volatile stock has the biggest weight in the index, about 3%. And then we spread it across the rest of that 100. So again,
does that force you to be also a disciplined seller when you're rebalancing? So, again, volatility can be upside. So if a stock goes parabolic and, does a Tesla or does something like that, it does a Shopify and, goes into a nonsensical valuation scenario and its volatility has increased so significantly, does that allow us to be forced sellers as well and create some discipline?
It certainly could. I think a fairly good rule of thumb, kind of something out of the Farmer's Almanac, is the market takes the stairs up and the elevator down. And so there can be upside volatility, but it doesn't usually compare nearly as much to the downside volatility. So when we see spikes in vol, it is usually a pretty good indicator of disagreement about the value of a company. And that's the fundamental thing to understand about price volatility of a stock. Tesla is a great example. That stock swings wildly, and it's because all those sophisticated portfolio managers up and down Bay Street and Wall Street that are PhDs in finance that are trading against each other every day. They can't agree on the future of Tesla. Some want it, some don't. Some are betting against it, some are betting for it. And so we see that in the fluctuation of Tesla's price. And we won't really know that, the post-mortem until it's all over. This type of index, though, says, I want to sit those out. Good example in the US and Canada has been energy. We're all familiar with the bumpy ride energy has had over the last few years. And typically it has a pretty good weighting in both the TSX composite and the S&P 500. But because of the uncertainty around the future of oil prices and of drilling activity, of pipelines and regulations and all the components that go into making money as an energy company, those have been very volatile stocks. And by screening and getting out and staying away from volatility, we've held very little positions in energy. And it's because the uncertainty is just so high. We'd rather migrate towards things where there's more confidence and more certainty. Participate on the upside, but protect on the downside.
Gotcha.
So here's the weighting of the S&P 500 low volatility index right now. And that was as of the last rebalance in January. And you can see historically, because it is so defensive, it has a big allocation to real estate, a big allocation to utilities, and typically is underweight technology. So over the long run, we'll see this index move. And I think one of the things that's happening today is a lot of change is underfoot, right? big tech companies have been more stable. Utility companies have been fairly volatile. And it's actually made for a more volatile ride in the low vol index and the S&P 500 low vol index than we would expect.
Yep.
So recent performance has been pretty choppy. But if you follow along here, and this is a really busy slide, but try to stick with me here because I think it'll help you understand where we could be headed no matter what happens in the market. So this is the exposure to all those sectors I talked about over time, back to the early 90s. And if you zero in on the dark purple in the middle of this chart, it's really wide there for a period of time from about 02 to 07. This is the exposure to financials, right? Bank stocks, REITs, they were combined together at that time. About 1 in 3 stocks in a low volatility portfolio would have been a bank stock or a financial stock. And then what happened is something fundamentally changed in our economy and our global financial system and in our world. And by the first rebalance that we went through as the crisis started, the global financial crisis started to unravel, this index went from a third, so about 33 stocks, down to I want to say 3. And then in one more rebalance, it was at just 1 stock. And it didn't care what the past had looked like. It just cared what the current volatility readings were telling us. And what they were saying is nobody's sure what the value of a bank stock is anymore. And so sit it out. I don't care if you were in RBC at X amount and today it's half the price. Sit it out because it actually could go down by 90%. I mentioned I worked at Merrill Lynch. That was the experience. We were at $90 a share. We had a price target of 130, and I saw that company nearly go to 0. But there are a lot of smart people that were convinced that it was oversold at $20, right? This type of approach is unemotional and says we just want to get away from risk. And so I expect that as we rebalance in May, the low volatility index, there are going to be some big shifts. And for example, technology there that's weighted at 6% will likely be a much bigger position in the portfolio, and utilities will be trimmed. So we don't pretend to have a crystal ball in a low volatility screen. We just, as the market changes structurally, we let volatility tell us where to avoid risk going forward. And so we expect pretty big changes in the rebalance.
And when is that date for you guys?
It's the 3rd Friday of May, I believe.
And we saw a little bit with rebalancing kind of, Jennifer, at the end of March going into April 1st. We saw that huge surge going into the end of the quarter as indexes and pensions had to rebalance, between get their 60-40 or 50-50 weightings. We saw that big surge come and then rollovers again as we were still washing through liquidity. So, yeah.
Yep. And this is, again, unprecedented. So we'll see some big shifts. And my expectation is the market's going to tell us where the risk still is. I own some energy stocks, and I can tell you when I check on how they're doing day to day, whichever direction the market's going, they're going faster, down or up, right? So we expect this rebalance to be pretty substantial. Now, the goal of this, again, all of this is to reduce the portfolio's volatility over time. And what you have here is rolling 10-year periods back to the early 70s, where we analyze the low volatility screen against the parent index, which is the S&P 500. And you can see how remarkably consistent that reduction is. And so even though right now this last month and a half feels like a real anomaly because of the exposure to utilities and the lack of big tech, over time we still expect to smooth that line out and reduce volatility. So hopefully we can look at this in another decade and see that substantial gap between what a regular equity portfolio in the 500 would look like versus the low volatility screen.
Yeah. So I think I had the benefit of seeing some of the other slides we may or may not use. And I think one of the things, just in the interest of time to keep these segments short, that I really kind of wanted to jump into is that during unprecedented times, unprecedented things happen. But historically, the discipline from implementing strategies that align with our clients' goals, like that of capital preservation, income, modest growth over a market cycle, is to understand that talking about the rolling 10-year, the S&P 500, and your low volatility has screened, I think it's slide 22 if you have it, or if the rolling 10-year number would be the one where low volatility outperforms in 74% of the observations that we've seen going back to since 1982. Now, I have that in mind, and we might have pulled it out of it, but what we're looking at is a repeatable process that aligns with our philosophy and around what we're trying to achieve. And really appreciate you taking this time as our partner. And I look forward to kind of jumping on our next calls when we find some time to discuss, albeit equal weight, as well as ESG, which is getting a lot of attention right now in the marketplace, and can sometimes even be a hot button here, being predominantly based out of Western Canada. But I wanted to thank you again for coming to chat with me on Zoom today, Travis, and why don't we look forward to talking again soon.
Sounds good. Thank you, Chad.
Yeah.